Hi, Matt McAleer, August 2nd, just after the close here at Cumberland Advisors. Another interesting week. Had some headline risk, had some headline whip off of the Trump tariff news. We're actually trading very nicely Thursday morning across the board in all sectors before the news that Trump was going to jack the tariffs up a further 10% with, maybe higher or maybe short-lived. So not a lot of transparency or clarity there, and the markets didn't take that well. So what do we like? What don't we like? And let's make a couple of comments about the fixed income market to close things out, because that was shocking this week. So in terms of the equity markets, we talked a couple of weeks ago on this video what was troubling us about the equity markets. Keep in mind, we're really looking at 28.75 to 30.50, let's call it, as an S&P range. Have had a lot of trouble with supply when we get through that 30-20 area, 30-30. We've had good support down at 28.75 to 2900. That's where we are. Often, markets react to headlines depending on where they sit. Where we sit in the markets has a heck of a lot to do with the short-term action. Short-term action we do try to dismiss, we try to backseat it. But as we move through 3,000, up near that resistance, that the tariff headlines were too much and supply came back into the market. So what do we like? We're still in that range. In past markets, the past 3 times we've moved, going back 18 months, 19 months now, when we've moved up into this range, we were quickly repelled. Market fell apart, fell rather quickly. Now we've been in this range for 2.5 months. We're starting to build a base here in this spot. That's a positive. What's a negative? Well, if you recall 2 weeks ago, we talked about the speculators, the smallest option traders, the odd lot traders in the equity-only options market had reached the highest, the lowest put-call ratio, or said another way, the highest percentage of calls being bought versus puts since last September. We know the smallest traders are your most aggressive traders, especially in the options market. Many are in the options market on a dollar level, feeling they can return speculatively more money in the options market versus the equity market. We watch that speculative set very closely. As the calls reached a peak 2 weeks ago, we mentioned we didn't like that. That was a little bit of a signal that there was some high speculation in the market. So we've corrected from there. We've corrected back into the range. We'll see what next week brings. One thing, an additional thing that we find interesting, and to get into fixed income in a moment, we're now at par on the dividend yield on the S&P 500 versus the US 10-year, both at 185. So now you start to have an allocation decision. Perhaps you were a 50-50, 60-40 one way or another. You're going to start perhaps to rethink that allocation decision. Does that create additional demand or not? There's no perfect answer, and we don't know that. But these allocation decisions on the large side, in the large dollar investor side, whether it's pensions, whether it's family offices, whether it's large institutional accounts, that's something talked about over the weekend, talked about weekly, talked about monthly. Right now at a 185 versus a 185, very interesting allocation decisions. So that kind of brings us into that fixed income. Last week we're at a 205, 206. I forget where it closed. The 10-year closed last week. Closing at a 185 is a vicious downward yield move. Obviously, prices moved higher. Our bondholders, people owning bonds, had a very, very nice week. We think of that in 2 ways. We're pleased to see that strength in bond prices. The problem is, over rolling 20-year periods, going back the last 20 years, you're going to find about 95% of your performance is made up of coupon in your total return. These depressed coupons really depress income, and nationally we have a lot of people that depend on municipal bond income, treasury income, fixed income mutual fund income. We're going to be looking at tighter yields. So that's something we have to consider. Our duration is tight. Duration, remember, is a interest rate risk number that we keep an eye out on. We're under 3 in our tax-free municipal strategy and our taxable. And the reason we're that tight on duration, or defensive versus higher rates, is we're able to pick up 170, 180, 190 in a short-term treasury. So do we want to go out 10 years? Do we want to go out 15 years and take interest rate or duration rate risk when we can pick that up in a short instrument? Not yet. We'll see again what the next few weeks bring. Any questions or thoughts that you'd like us to discuss or have in terms of securities and portfolio abuse, feel free to email us or comment on YouTube, and we'll try to get back to you. Have a great week.